I spent a lot of years in classrooms learning about business. Balance sheets, income statements, discounted cash flow models, efficient market theory, all useful things, don't get me wrong. But somewhere along the way, I realized that the people who built enormous wealth, the ones who made decisions that compounded over decades, they weren't just applying what they learned in business school. They understood something else, something quieter, something that doesn't fit neatly into a semester course or a textbook chapter. And that realization changed everything for me. The thing is, business education does what it's designed to do. It teaches you frameworks. It gives you vocabulary. It shows you how to read financial statements and calculate ratios and build projections. These are important skills, but they're tools, not wisdom. And there's a big difference between knowing how to use a hammer and knowing which nail to hit. Most business classes focus on the mechanics of business without ever really addressing the deeper question of what makes certain people consistently make better decisions than others, year after year, decade after decade. When you look at the people who've built serious, lasting wealth, you start to notice patterns that have nothing to do with the complexity of their education. In fact, you often notice the opposite. Many of them gravitate towards simplicity. They avoid businesses they don't understand. They don't chase the newest trend or the hottest sector. They're almost boring in their consistency. And that's the first thing that business classes rarely emphasize. Simplicity is a competitive advantage. In school, you're often rewarded for demonstrating complexity, for showing that you understand sophisticated models and advanced theories. But in the real world, complexity usually works against you. It creates more ways to be wrong. It makes it harder to see what actually matters. Warren Buffett talks about this idea of staying within your circle of competence. It sounds simple, almost too simple to be profound, but think about what it really means. It means you admit there are things you don't understand, and instead of pretending otherwise, you simply avoid them. Most people can't do this. Their ego gets in the way. They see an opportunity everyone's talking about and they feel like they should have an opinion, should take a position. But the billionaires who've lasted, they're comfortable saying, I don't know, or that's not for me. They understand that you don't get paid for degree of difficulty. You get paid for being right, and you're much more likely to be right when you stick to what you actually understand deeply. Business school teaches you to analyze opportunities. It doesn't really teach you when to walk away from them. There's no course called The Art of Saying No. But that might be one of the most valuable skills in business. Every yes is also a no to something else. Your time, your capital, your attention, these are all limited. The best investors and entrepreneurs understand this viscerally. They protect their resources carefully. They know that avoiding mistakes is often more important than hitting home runs. If you can avoid big errors, stay in the game long enough, and make reasonably intelligent decisions, the math works in your favor over time. But one catastrophic mistake can wipe out years of gains. This connects to something else that's rarely taught, the importance of thinking about downside before upside. In business classes, you spend a lot of time on expected returns, on maximizing value, on growth opportunities. All the focus is on what you might gain. But talk to someone who's managed money or built businesses through multiple cycles, and they'll tell you they spend more time thinking about what they could lose. Not because they're pessimistic, but because they're realistic. Markets change. Competitors emerge. Regulations shift. Technologies disrupt. The future is uncertain. When you make a decision, you need to ask yourself, if I'm wrong, can I survive it? Can I live to make another decision? This is the idea of margin of safety, and it's fundamental to how successful long-term investors think. You don't need everything to go perfectly right. You build in enough cushion that even if things go moderately wrong, you're still okay. You buy businesses trading well below what they're worth. You don't use excessive leverage. You keep reserves. This sounds obvious, but it's surprisingly rare. When times are good, people forget about risk. They start to believe the good times will last forever. They stretch for returns. They take on more debt. They cut their margin of safety to chase an extra point or two of gain. And then when conditions change, as they always do, they're exposed. Business education also tends to focus on intelligence as the key variable. You're taught to analyze, to calculate, to optimize. And intelligence matters, of course it does. But beyond a certain baseline, temperament matters more than IQ. This is something you only really learn by watching people over time. You see brilliant people make terrible decisions because they can't control their emotions. They panic when markets fall. They get greedy when everyone else is greedy. They change their strategy based on last quarter's results. Meanwhile, you see people with no exceptional intellectual gifts do extremely well because they can sit still, stay rational, and stick to their principles when everyone around them is losing their heads. The emotional discipline to do nothing when nothing is the right move, that's rare. We're wired to act, to feel like we're making progress, to respond to what's happening around us. But so much of investing in business is just waiting for the right opportunity, waiting for your investments to compound, waiting for a crisis to pass, waiting for a good business to become available at a reasonable price. This waiting isn't passive, it's active patience. You're staying alert, staying informed, staying ready, but you're not forcing action just to feel productive. Business schools also tend to teach you to focus on the numbers, on the quantitative. And numbers are important. They're the language of business, but they don't tell you everything. Some of the most important factors in business success are qualitative. Does management have integrity? Do they treat their shareholders like partners or like marks? Is the corporate culture focused on long-term value or short-term appearances? Does the business have genuine competitive advantages that will last, or are they temporary? These questions don't have numerical answers. You have to develop judgment. You have to learn to read between the lines, to notice what people don't say, to understand the incentives that drive behavior. And that's another thing, incentives. Show me the incentive, and I'll show you the outcome. This principle explains so much of human behavior, yet it's barely emphasized in traditional business education. People respond to incentives, often in ways they don't even consciously recognize. If executives are paid based on quarterly earnings, they'll optimize for quarterly earnings, even if it hurts long-term value. If salespeople are compensated purely on volume, they'll push volume, even if it means selling to customers who shouldn't buy or making promises that can't be kept. If analysts are rewarded for making bold predictions that get attention, they'll make bold predictions. Accuracy be damned. When you're evaluating any business or investment, you need to understand the incentive structure. Who benefits if things go well? Who bears the cost if things go poorly? Are the incentives aligned with what you want to happen? If the people running the business get rich whether shareholders make money or not, that's a red flag. If their wealth is tied directly to the long-term success of the enterprise, that's encouraging. This seems obvious when stated plainly, but you'd be amazed how often people ignore incentives and then act surprised when people behave in predictable ways. There's also the matter of thinking in probabilities rather than certainties. Business school teaches you to make projections, to build models, to forecast outcomes, and there's nothing wrong with that as a tool. But the danger is starting to believe your projections are reality. They're not. They're estimates based on assumptions, and the assumptions are usually wrong in some way. The future is a range of possibilities, not a single point. Successful investors and entrepreneurs maintain what you might call probabilistic thinking. They know their base. Case might not happen. They think about what else could happen and how likely those scenarios are. They update their views as new information comes in. They're not married to being right about their previous prediction. They're trying to be right about what to do now, given what they know now. This flexibility of mind is crucial but hard to teach. It requires a certain intellectual humility. You have to be willing to say you were wrong, to change course, to admit that your earlier analysis missed something important. A lot of people can't do this. They double down on failing strategies because admitting error feels like admitting weakness. But in business and investing, being able to change your mind in response to new evidence isn't weakness, it's survival. Another thing you notice about people who build lasting wealth is they think in decades, not quarters. This is almost the opposite of how most businesses operate and how most business education is structured. Everything is focused on near-term results. This quarter's earnings, this year's growth rate, the current market environment, and sure, you need to pay attention to these things. But the biggest gains come from positioning yourself for long-term trends, from owning assets that compound value over many years, from building businesses that get stronger over time. The problem is thinking long-term requires you to endure looking wrong in the short term. If you're investing based on where you think things will be in 10 years, you might look foolish in year 2. The market might think you're wrong. Your peers might think you're wrong. You have to have enough conviction and enough independence of mind to stick with it anyway. This is psychologically difficult. We're social creatures. We care what others think. We feel the pressure to conform, to chase what's working right now. But that's exactly why long-term thinking is such an advantage. Most people can't do it, which means there's less competition for long-term opportunities. Compounding is another concept that's taught mathematically but not truly understood emotionally. Everyone knows the formula. Everyone can calculate compound interest. But knowing the math and really internalizing what it means are different things. Compounding is boring. It's slow. It doesn't feel dramatic. In the early years, the gains are modest. A 10% return on a small base isn't exciting. But if you can keep that going year after year after year, something almost magical happens. The gains start to accelerate, the base gets bigger, so the same percentage return generates larger absolute gains. Time becomes your ally instead of your enemy. But here's the thing about compounding. It requires patience and it requires not interrupting the process. Every time you pull out, every time you change strategy, every time you start over, you reset the clock. The people who benefit most from compounding are the ones who find something that works and then have the discipline to stick with it through the boring middle years, through the times when nothing seems to be happening, through the periods when other people are getting rich fast or doing something else. This is harder than it sounds. FOMO, fear of missing out, is real and powerful. Watching others make quick money while you're plodding along slowly tests your resolve. But the plotters, if they keep plotting, often end up far ahead in the end. Business education also tends to emphasize optimization, doing everything as efficiently as possible, maximizing every variable. And there's value in that. But taken too far, optimization makes you fragile. When you optimize for one specific set of conditions, you become vulnerable when conditions change. It's like designing an athlete to run one specie. Fick race on one specific track and one specific weather condition. They might set a record that day, but change any variable, and they struggle. The businesses and investment strategies that last tend to have some redundancy built in, some slack, some robustness. They're not perfectly optimized, but they can handle a range of outcomes. This connects to the idea of room for error. Life is uncertain. Business is uncertain. You don't know what's coming. So you build your life and your business to withstand a range of possibilities, including some bad ones. You keep some cash even when you could deploy it for slightly higher returns. You avoid strategies that require everything to go right. You give yourself options. This isn't about being fearful or pessimistic. It's about being realistic and giving yourself the best chance to survive long enough for your good decisions to compound. There's also something to be said for understanding that business isn't just about money. It's about people. Business school teaches you finance, strategy, operations, marketing. But businesses are ultimately collections of people making decisions and working together. The quality of those people matters enormously. Their character, their judgment, their work ethic, their ability to collaborate. You can have a great strategy executed by mediocre people and fail. You can have a decent strategy executed by exceptional people and succeed beyond expectations. Yet hiring, culture, leadership, these soft factors don't get nearly the attention they deserve in formal education. The best business builders understand this. They're obsessive about who they work with. They're willing to wait for the right people. They're willing to pay up for quality. They know that a great person in a role creates value far beyond what they cost. They also know that the wrong person in a key position can destroy value, damage culture, and create problems that persist long after that person is gone. This seems obvious, but you see it violated constantly. People hire based on credentials or interviews rather than really understanding character and fit. They tolerate mediocrity or bad behavior because someone has a specific skill. They fail to invest in developing their people, and they wonder why their businesses underperform. Another underappreciated principle is the power of saying nothing. We live in a world that rewards constant communication. having an opinion on everything, broadcasting your thoughts. But some of the most successful investors and business people are quiet. They don't do a lot of interviews. They don't tweet their every thought. They're not trying to build a personal brand. They're just focused on doing their work well. This gives them an advantage. They're not locked into public positions. They don't have to defend yesterday's opinion. They can change their mind quietly. They can act without telegraphing their moves. They have room to think without outside pressure. There's also something powerful about understanding what game you're playing. Business school often presents business as a single game with standard rules. But in reality, different people are playing different games. Some are trying to build multi-generational wealth. Others are trying to get rich quick. Some are optimizing for lifestyle. Others are chasing status or fame. Some are working on something they find meaningful regardless of the financial outcome. None of these is wrong, but they require different strategies. The problem arises when you adopt someone else's strategy without realizing you're playing a different game. You see someone making a lot of money quickly and try to copy them, not realizing they were taking risks you can't afford or playing a game you don't actually want to win. The billionaires who build lasting wealth are usually very clear about what game they're playing. They're playing the long-term, compounding game. They're not trying to get rich next quarter or next year. They're building something that can generate value for decades. This clarity allows them to ignore most of the noise, most of the opportunities, most of the pressure to do what everyone else is doing. They have their own scorecard, and they're comfortable with that. You also learn over time that mistakes are inevitable. You're going to be wrong about things. You're going to miss opportunities. You're going to make bad decisions. The question isn't whether you'll make mistakes, it's how you handle them. Do you learn from them? Do you admit them quickly and move on? Or do you compound them by denying they happened, by throwing good money after bad, by letting ego prevent you from correcting course? The best investors and business people have made plenty of mistakes, but they tend to make small mistakes, not catastrophic ones, and they learn from them. They don't keep making the same mistake over and over. This requires honest self-assessment, which is rare. Most people are good at explaining why their successes were due to skill and their failures were due to bad luck. But reality is messier. Sometimes you succeed despite making poor decisions because luck bailed you out. Sometimes you fail despite making good decisions because circumstances turned against you. Being able to separate luck from skill in your own results, being able to say, I got that right or I got that wrong independently of the outcome, that's a form of wisdom that takes years to develop, but it's crucial for getting better over time. There's also the matter of reputation and trust. These aren't line items on a balance sheet, but they're among the most valuable assets you can build. A reputatio. For integrity, for keeping your word, for treating people fairly, this opens doors. It creates opportunities. It allows you to do business on a handshake. It means people want to work with you, want to invest with you, want to be associated with you. Conversely, a reputation for cutting corners, for being dishonest, for exploiting others, this closes doors, and often in ways you don't even see. People simply avoid you. Opportunities go to someone else. Nobody tells you why. Building reputation takes time and consistency. You can't fake it. You can't shortcut it. You just have to do the right thing over and over, even when it costs you something in the short term. This is another case where the long-term thinkers have an advantage. They're willing to sacrifice a near-term gain to preserve their reputation because they know that reputation will pay dividends for decades. What strikes me most looking back is how much of what really matters in business comes down to character and judgment rather than technical knowledge. The technical stuff you can learn, the analysis, the modeling, the frameworks, these are teachable. But having the patience to wait for the right opportunity, the courage to act when everyone else is afraid, the discipline to stick with your strategy when it's not working yet, the humility to admit mistakes, the integrity to do right by your partners and shareholders, the independence to think for yourself, the wisdom to know what you don't know. These qualities are harder to teach. They're developed through experience, through reflection, through seeing many cycles and learning from them. This is why I think the title of this piece resonates. It's not that billionaires know secrets that are being deliberately hidden. It's that the most important lessons about building wealth don't fit neatly into a curriculum. They're not dramatic or complicated. They're simple principles consistently applied over long periods of time. Stay rational, think long-term, understand incentives, avoid big mistakes, stay within your circle of competence, be patient, say no to most things, protect your downside. Let compounding work, do business with people you trust, build reputation, keep learning. None of this is exciting. It doesn't make for viral social media content. It won't make you rich next week. But that's precisely why it works. Most people can't execute on these principles because they're too busy chasing the next hot thing, too impatient to let things compound, too emotional to stay rational during volatility, too concerned with what others think to forge their own path. The few who can execute on these boring, obvious principles quietly build enormous wealth over time, not because they're smarter, but because they're more disciplined, not because they have secret knowledge, but because they understand and apply the fundamentals that most people know, but few actually follow. The real insight, if there is one, is that knowing what to do and actually doing it are completely different things. Business classes can teach you the what. They can't give you the temperament, the patience, the discipline, the character to actually do it year after year, especially when it's hard, especially when you look foolish, especially when you're tempted to take shortcuts. That only comes from within, developed over time through experience and reflection. And that, more than anything taught in any classroom, is what separates those who build lasting wealth from those who don't. The principles aren't secret, they're just hard to follow. And the people who figure out how to follow them, who make these principles part of who they are rather than just ideas they know, they quietly win over time.